Good evening, everybody. Hope everybody is well and had a good Father's Day weekend. And we begin week 3 of 635, live and in color from Claremont, California. A warm Claremont, California this evening. So we've gone the Tommy Bahama look this evening. Casual, but professional. Tonight, our topic is financial statement analysis. We're going to probably bore you with some of these things because most of you probably are aware of these, but to refresh your memories and get you ready to get into more strategic decisions and analysis later on in our course in the coming weeks. Financial statement analysis from chapters 3 and 12, ratio analysis, and financial forecasting using the additional funds needed model as a way of determining capital requirements based on your current financial statements. We also have a case study this evening. It will be posted a little bit later to your Blackboard. And that case study is going to be on the first 4 chapters of our study, capital financing and some tools of capital financing, the definitions and analysis of time value of money, bonds, and stocks. That will be our case study, and more on that a little bit later. I have changed my mind in 24 hours since I gave you the introduction video of yesterday, where I, in that video, determined that the case number 1 will be in a PowerPoint file format. I have changed that in the course of the day of listening or reviewing what I think is needed for me to see how we all are adapting to business 635, and I've changed that to an open analysis where you can use any format you desire to give your answers to the information that I'm requesting. So we'll talk more about that later as well. After we conclude tonight's topic, then we begin into strategic decision making involving capital investment and more managing financial resources type stuff as we head into week number 4 next week. So that's where we stand, that's where we are, and let's begin. Last week we looked at a spreadsheet that was in week 2 that concerned itself with the definition of capital financing and time value of money, bonds, stocks, risk and return. And a couple of reviews off that information, just making sure everybody is aware of it and maybe followed up on it. What we're really looking for in this class when we're managing financial resources is what the asset is going to pay us in value or in cash flows into the future, and what is that asset's present value today compared to the investment in the asset, all relative to the amount of time net over the course of the ownership of that asset and the cost of capital or the interest rate on the money involved. And you all have seen this in various formats and areas in Business 500D and other finance topics, and even in some accounting courses. But just to refresh your memory, we looked at a $100,000 investment last week that was going to generate, excuse me, it was going to generate $140,000 in cash flow over 10 years. 10 years was the estimated life of this investment, and the estimated life was determined by how many years we can depreciate that asset. The depreciable life determines the financial life of an asset. Again, you may own an asset for 30 years, but its financial life, as far as analysis is concerned, is the depreciable life of that asset. So the depreciable life of this example is 10 years, and it's generating over $140,000 a year over the course of 10 years. That cash flow is determined by revenue minus expenses, net income less taxes, any working capital or depreciation add backs for working capital and for cash flow. The net effect, and we'll talk more about that format later on, but the net format is $140,000. That asset of $100,000 cost us 4%, or excuse me, yes, 4% in its money. In other words, we replaced that 100,000 and it cost us 4% to come up with that $100,000. That 4% could be a bank loan. That 4% could be the expected rate of return or the expected rate of return of the equity that was used to fund it, 4%. That 4% could have been used by taking it out of existing profits in some type of investment and giving up that investment of 4% and investing into this $100,000 investment. That's our cost of capital. That's chapter 9, and that's more analysis next week, but that's what it cost us to get the 100,000. So that's our discounted cash flow rate for this example. So then we take that 140,000 and we discount it back over the 10 years at 4%, and we get $108,427. That's the discounted cash flow. In other words, that's the present value of that investment of 100,000. The future value is, of course, the $140,000, which are gating into the future. But we're doing a present value analysis of that asset because we want to compare what we're making in today's dollars to what we're investing in today's dollars. And that's what we call the net present value number. The net present value number is $8,427.28. Hang on, folks. I'm going to turn off some people's mics. I'm getting some feedback. Alicia, I'm turning off your mic. Efren, you turned off your mic. Thank you. Thank you. Sorry I had to do that directly, but mics are off when you come on because I get feedback and then I get mad. No, I don't get mad. Do I get mad? No, I don't. All right. Mr. Robles, nice to see you this evening. You're the only one that I see with their camera on. Good to see you. So as I was saying, the net present value is $8,400. In other words, this investment is going to generate more than enough return to warrant the investment at a 4% cost. The variable factors in that analysis are how much cash flow is being generated, the length of time of the length of the asset, or the financial life of the asset, and the cost of capital that you gave up or you had to pay to acquire that 100,000 to invest. Typical example of cash flow discounted at a cost of capital over a period of time. What is its present value? We're going to be doing this over and over in the coming weeks as a way of determining the value of investment today in regards to the risk. What's the risk in this example? The 4%. The cost of the money. That's the risk. The financial life or the depreciable life is not a risk. That's according to accounting guidelines. But the risk is the cost of money. The higher the interest rate, the higher the risk, the less chance of making a profit, the less chance of making over $100,000. That's the goal of any investor of assets, either if you're investing or you're if a CFO of a corporation or a proprietorship and you're trying to determine what's the economic sense of investing in money generated cash flow into the future. The time, the cash flow, the cost, the net present value. So that's a review of basically the most important part of chapter 4, and most of us have seen these in a variety of versions before. Chapter 5, it was about bonds, the major financial tool of corporations to acquire capital. Why? It's only interest only until maturity. Naturally, corporations going to grab that deal if they can. All they have to do is pay interest to the bondholders until maturity. That is an example of an unamortized loan, where most banks have amortized loans. The banks have amortized loans because why? The risk is on them. Tomorrow afternoon, the Federal Reserve of the United States government is going to be announcing their results of the latest quarter stress tests of major banks, the stress test. And the stress test will tell us the bond's ability to cover risk in lending their money out. And if their stress test proves high, that means they have to give their money to clients who have excellent credit, or they have to collect their money as fast as possible on that loaning of money. That's called amortization. Interest and principal paid up front and every month. Whereas in a bond holding, All you pay is interest only until maturity. That's very attractive. And the attractive thing about that is because then you can develop your capital budgets on where you put that money that you receive through the bank financing and make sure you have enough cash flow to cover the interest payments and develop a return on that investment to cover the maturity and at the end of the length of time of that bond. That's why bonds are so attractive to corporations. It's very attractive because it's interest only. As all of us know, when we get a car loan, we talked about this last week, when we get a car loan or when we get a mortgage, we have to cover the risk to the bank. Thus, we have to pay interest and principal payments every month. The bank cannot afford to give us unamortized loans unless our last name is Trump, Buffett, or Gates. All right. But if we don't have any of those three last names, we have to do an amortized loan. But the attractiveness of bonds for corporations as a form of financing is because the risk is covered by the collateral you put up on the corporation. The most corporations have hundreds of $millions of assets. Those assets can be used as collateral to cover that loan, that bond issue. So if you do go in default, you can sell off assets to cover that financing. So bonds are very important. The difference between us, individual borrowers, and corporate borrowers is risk. And that risk is covered by us, individuals, by making principal and interest payments on all our financing. That risk is covered on credit card debt, which is technically short-term debt, meaning our risk is covered because they can pull that card whenever they want. But for corporations with lower risk, more collateral, they can pay interest only for many years with the principal coming at the end. But the only reason the investors lend them the money and buy those $1,000 lots of bonds is because they know the corporation is backing that debt with their assets. Thus, it makes it less risky. Now, if I wanted to sell that bond in the market before its maturity date as an investor, the changes in interest rates in the bond market will warrant how much money I get off selling that investment in the market. Interest rates go up, bond prices go down. Interest rates go down, bond prices go up. Because the relationship to the coupon rate of the bond, if in an inflation or inflated market, your investment loses value because you can get higher interest in the market instead of that coupon rate on that bond. Vice versa, the way the economy is now, it makes it attractive for bond buying because interest rates are very cheap. So the bond prices maintain their value over their life because the coupon is more competitive or higher than current interest rates. So that's the bond market. That's the credit market, driven by interest and driven by the credit and risk of the organization borrowing the money. In our class, which we studied corporate finance, that risk is covered, thus we can pay interest only over a period of time on our debt financing. Makes it very attractive. Then we got into chapter 7 last week, which was about stock and equity, a whole other different animal. In bond investing, you're a creditor. They pay you first. In equity financing, you're an owner. You get paid last. You get paid after the company makes their profits, or in some cases, when they don't make profits, you still get paid. But equity is a form of investment. It's in valuation of the company. Either the public valuation of the company or the intrinsic valuation of the company. Two important words for advanced MBA students. Market valuation of a company, called market cap, the current stock price times the number of shares of stock outstanding. That's the corporate value of the company in the market. Right now, leading the way is, I believe, Microsoft at $1.4 trillion market cap, followed closely by Apple, Amazon, and Google. They're in the $1 trillion range. That's their market cap. That's their market value. but more importantly is their intrinsic value, their true value. Remember, the market value of a company is based on what the market thinks they are. The flavor of the month. I always said, crying at the moon for years and years, Tesla is overvalued. Its market cap is not that high, not with that debt and not with those profit margins. But people keep buying the stock because they like the company and they think it's cool to own Tesla. But its true value is not that high. And that's where we get into the intrinsic value of a company. Its true value. Its true value in relationship to its risk, its growth potential, and its risk in the market. So stock is an interesting thing because stock gives you a value of your ownership, but the only way to cash out of that value is you got to get rid of that value. You got to sell it. That's kind of tough. Company's doing well. Geez, I've made $100 on each share of stock in my investment. The only way I can get that money is I got to sell it. I got to liquidate. You got to give up your ownership. That's why a lot of stock is traded and held for a long time, held to pass on to sons and daughters, held to pass on when you needed to buy a house or to fund a college education. But stock is more long-term, where credit bonds have a time period. 2 years, 3 years, 4 years, 10 years, 20 years, 30 years. It's a time period. Stocks have no time period. The only time period in stocks is if the company dissolves or is sold. So the true value of a company is the company's intrinsic value of that company. And that's where we got into Chapter 6. How to determine the true value or the true expectations of a company. Well, you determine its expected return on the risk in the market. That's the capital asset pricing model. Comparing the risk-free rate to the market return rate to the company's risk in the market, you can determine its expected return. That expected return can be divided into the cash flow generated by that company, and you can determine the real value of a business. It's called corporate valuation. How do you determine that? We'll talk a little about it and see in just a minute. Free cash flow. The free cash flow divided by its expected return. Also, in many cases, the expected return could be the cost of capital. If you're financing your business entirely by equity, your cost of capital is that expected return in the market of your company. And we looked at it last week where we took the risk-free rate plus the market premium return times the beta of an example company and determined that the expected return is 7.7%. The risk-free rate is the 10-year United States Treasury yield. The market premium is the difference between the market return and the risk-free rate. And the risk is what you can look up in Yahoo Finance of any publicly traded company. Matter of fact, you're going to be doing that in case number 1 this next week. You're going to be selecting a Dow Jones Industrial Index company, one of 30. And you're going to be doing a credit analysis of that company and determining its expected return by determining and looking up the beta of the company. That's one of my assessments of this first case. See if you can do that. If you can go and do the research to locate the beta of a company, the risk in the market today, and determine its expected return using the capital asset pricing model. I give you the risk-free interest rate. I give you the market return rate. You can determine its equity value today based on that calculation. Now, the bad thing about this analysis is it's as of today. Tomorrow, it could be a whole different number. But it allows you to put a stake in the ground to determine the expectations of a company's equity position. And that is huge. It's not a future value, it's a present value of ownership of expectations of the company. Then you can use that expected return percentage to discount future growth potential of the company into a valuation of today. Wow, Now we're really talking about advanced finance here. This is what you're paying your money for here, is be able to distinguish that, determine it, and tell me what happened. Case number 1, question number 4. Give you something to look forward to in another couple hours. So that was our discussion last week. The ability to discount and determine future flows of money into the future and to their true value today, based on the amount of time, the amount of the cash flow being generated in the future, and discounting that back at its current cost or expectations. We looked at the main capital financing vehicle for corporations as bonds. Bonds are very manageable because you know what you have to do. You know how much you got to pay. You know when you got to pay it. Pretty cool. But a big and sexy vehicle of capital financing is issuing stock. Stock is sexy because people can make a lot of money. Why can they make a lot of money? The fear of the unknown, gambling. You're basing your stock buy today on hopefully the company performs in the future to provide you with stock growth. But it ain't guaranteed. Whereas a bond, it's guaranteed. You are going to get interest payments every year, coupon payments, and you are going to get the principal at maturity. You are. That's a given fact. It's a contract. It's a legal agreement in the financing. No legal agreements in stock. You have no idea what's going to be the future. You can look on the past performances of the company going back, in the case of many corporations, 40, 50, 60 years. But that doesn't guarantee performance into the future. What guarantees performance in the future is the company managed correctly? Does the company have a good market share? Is the company constantly developing new products? That's the future. That coupled with the solid management of the company as told by the financial statements, you take the risk of buying stock. And that leads us to our discussion this evening. What is the financial picture of a company? What do they look like? And that's financial statements. The financial statement analysis of a company. We looked at this last week. We looked at bonds and stocks, of which are shown on various financial statements, but this week we're looking at financial statements. In week 3, I have this file. You can download it and follow with me this evening, or you can just follow along with me and look at that file later. But this file is the somewhat simple, but the true financial statement of a company for the last 2 years. Their balance sheet, their income statement, their cash flow statement, their free cash flow, and financial statement analysis. All these things are taking the investment of dollars into assets, financial resources, and those financial resources, per the bean counters of your company, the accountants, are providing the data in the financial statements on a quarterly basis, in this case, in this example, it's annual, about the performance. And you as a financial capital investor or a worker have to interpret those. Please excuse me for this corny expression, but financial statements are like looking under the hood of a company. Looking under the hood, seeing the details, the inner workings of a company. Are they generating profits? How much debt do they have to finance their assets? Why? Because debt requires interest. And interest is the Darth Vader of all cost, fixed cost. It's a fixed cost. And if you work for companies, what's one of the first things companies try to eliminate and keep down in their overhead calculations is keep the fixed cost minimal. That's debt. It's called leverage. Financial statements tell us about the cash flow of the company. Where is it coming in from? Where is it going out? Where are we spending our cash? And financial statements tell us about are the operations of the company providing enough return to meet the obligations of the business. The combination of all these financial statements gives you, the financial analyst, the capital MBA analyst, information about telling you, okay, I know how they're funded, bonds and stocks. I know what their financials tell me. What do I do with this information to manage my business going into the future? And that's why right now in June of 2020, a lot of companies are kind of operating like this. Well, I think I know what's going to happen, but I can't see the future very well. Why? They have their financial information from the last quarter, the last 2 quarters, and it's a friggin' disaster. The pandemic, the loss of profits, the loss of revenue flows, the cutting of cost, the losing of market shares. So how am I supposed to make decisions going into 2021, 22, 23, where that's where the real asset return is? Remember, the main difference between short-term and long-term anything is short-term happens too fast. You don't generate enough return. It's 30 days. It's less than a year. You want to invest in capital investments in your plant and equipment and your products to generate returns for long-term, longer than 2 years, preferably 5, 10, 15 years, because that's how you pay your long-term debt. That's how you keep competitive in the market, by using that long-term return and investing into new areas. Financial statements tell us all these things. And our job this week is to remember that stuff. Remember what the bean counters have told us. What is a balance sheet? What is an income statement? What is a cash flow statement? And what does that term free cash flow mean to us? What is the trends that we see in financial statement analysis, comparing key financial ratios to prior years within our company? Or more importantly, how we stand vis-a-vis our competitors or the industry. And above all, and after that, what does it tell us about our future capital needs based on our current trends and efficiency or non-efficiency in managing our companies? And many of you know this already. If you work for a company that's stable, yes, they might be in a downturn now, but they always come out of it. Why? They know their numbers. They know the good and the bad and the ugly of their businesses, and they know how to manage them. The companies that fail and struggle and close don't have a handle on that, or they don't have enough capital to maintain that management style. So they close. And that's what we're seeing now over the next year, 2 years, are the companies that can survive this. Now, many of those companies are going to be pleading, please, please, Federal Reserve, keep those interest rates low and keep that cost of money low. You don't think realtors are telling the Federal Reserve, come on, dudes, keep those mortgage rates low so we can sell these houses? And at the same time, please, please, whoever is going to be president, whoever is going to be administration, to keep giving us those low interest loans, those tax breaks, those making our dollar or making our relationship to foreign markets more competitive than our foreign competitors. That's where the government comes into hand in all this. And if companies get that assurances and get their backs covered by the Federal Reserve and the federal government, then they'll be successful. But when those things start breaking down, or where you're unsure of that going to be happening in the future, that's where we come in, the manager, the financial manager. How do we interpret our specific business in the context of the overall market economy, and industry that we're in. You do that correctly by understanding these key topics. Are we efficient with our cash? Where's our trends going in regards to debt, equity, and profit positions? What are we going to need in the future to maintain competitiveness? How can we maintain that into the future? Well, now we conclude this third week of now putting all these factors together of the first 3 weeks into now taking this information and going forward and advance it into strategic decision making. We can't make any strategic decisions until we know how we're funded, how much it costs, and where are we succeeding in that by looking at our financials. Once we understand that and can see the trends and the information from that, then we can go forward and make strategic decisions. One of the things we're all going to see in the coming years is more consolidation of industries. Companies are going to merge, consolidate. They make themselves stronger to foreign markets, more competitive. Their cost of money goes down when they merge. It's called the economies of scale. You merge organizations, you cut your internal cost, the cost of your money goes down, you become more creative, efficient, you're providing value to your investors. Airline industry, automobile industry, the steel industry over the last 20 years, all have consolidated to make themselves more competitive and create value for their investors. Companies that are now going to be the next areas of that and already have started is in communications, telecommunications, technology. But most technology companies are making tons of money now, but eventually down the road in the future, in your lifetime, maybe not mine, they're going to be consolidated. They're going to be merging. Apple Computer and Disney. Oof. Facebook and Apple. That won't happen. Two cultures don't like each other. What's happening in the entertainment industry, communications, cable companies buying up movie houses, production companies. Streaming services like Netflix are the next ones who are going to be bought out by somebody. Why? Because you're consolidating in economies of scale and making yourself more efficient and competitive. You make these decisions based on the information we're talking about tonight. So these which you have to brush up your skills on. Case number 2 next week is going to concern itself with this discussion tonight. Reading information from the financials and now determining what's a strategy we should do. Tonight's case number 1 is based on the first 4 chapters of what I talked about earlier, time value of money, stocks, bonds, and the return or the risk and return. That's our case tonight. So each one of these cases highlights your calculations and what do they tell you? How do you interpret them? How do I go to the internet and look up information? How do I go to the financial resources of these companies or this data? And now what does it tell me? In our individual sessions that we talked about a couple weeks ago, excuse me, I told you that the main assessment vehicle of this class is you explaining to me what you find out. What does it tell you? Well, I take a look at this financial statement of this company from 2018 to 2019. It looks like they increased their stock position by 150,000 shares. They sold more stock, but they only increased their cash position by $6,700. Where in the hell is their cash going? Well, upon further analysis, we look at the balance sheet, we look at the income statement, we can figure those things out by looking at how they have delted in the last year. What's the change in cash? What's the change in all these account lines of the balance sheet? What's the change in the profitability of the country? Well, they made $253,000. A lot better than last year. How many dividends did they pay out based on the dividends per share? $55,000 in dividends they paid out. And how all these equate to the most important statement for investors and financial managers is the cash flow statement. Where did that 6718 come from? Well, it came from operations, financing, and investing, the cash flow statement. And this is really looking under the hood of a company. Why? Look at right here, cash flow from operations. Okay, the definition of cash flow from operations on the cash flow statement is your income statement, your profits or losses, adding back in depreciation as a non-cash expense, and then the working capital deltas operating liabilities. And notice right here, accounts receivable and inventory. Almost $700,000 in negative cash flow. Ouch. And why? Well, let's go back to the balance sheet. Here they are right here. Our receivable position increased by $245,000 and our inventory position increased by $1.7 million. Now that can be fine and dandy long term because eventually you're going to collect that money and eventually you're probably going to sell that inventory. But as many of you can attest with some of the jobs and some of the information you know about your own companies that you're working for, you want to just have enough inventory to meet demand. You don't want to have more inventory on the shelves or in the warehouses because that's costing you money. And you want to collect your inventories in 30 days, your receivables in 30 days, hopefully lower, because if you don't collect receivables, you're not having any cash flow. Well, at the end of December 2019, this company had $700,000 tied up in deltas of receivables and inventories that exceeded or spent or held on to cash that they didn't have access to in 2019. If I was a potential investor of this company, the first question I would be asking the managers of this business is, what are you doing about receivable and inventory management? It looks a little inefficient there. Clean it up. Or explain to me. Maybe they have an idea that those receivables and inventories will be liquidated in the next quarter. Well, that's a question I need to ask. So that's what the cash flow statement tells us. It tells us the deltas in operation, the deltas in financing. Oh, the company paid $920,000 on their debt position last year. $920,000. But where did they get the money to do that? They had to issue stock. They had to issue stock to pay that bill. Usually operations funds debt repayment. Not in this company, not with the receivables and inventory positions that they have. The cardinal rule of capital management is you issue securities long-term like common stock and invest that common stock in new assets to create long-term growth. This company invested long-term or took long-term dollars and paid back current debt. Not cool. Notice, investing. They only spent $17,000 on increases in fixed assets. That should be more like $1 million because now they've already spent this money and they have no return in the future ahead of them. There's no additional assets to make money. Ouch. Not cool. So these cash flow statements can really tell you what's going on in a business. And it doesn't take rocket science to figure out that a company that makes $253,000 in profits only generated $6,700 in additional cash. Well, that's because even though they issued new stock, they paid off a lot of debt and they had negative cash flow in the operating of their current operating assets and liabilities. Not good. So these three statements, the balance sheet, the income statement, and the cash flow statement, you guys have seen these many times before in accounting, in intro business finance classes, even in marketing classes. These statements tell the world how we're doing. It tells the managers of the business how we're doing. And yes, looking at it the first time, wow, we made a profit last year. Good job. Oh, we paid out a dividend. Oh, look, we reduced our debt. Good job. But at the same time, our cash position, zippo. We don't have much liquidity in this company. Can you imagine if the pandemic hit this company and their revenue sources dried up and they had this inventory and receivable balances hanging over them? No cash flow being generated? This has got the makings of a company that the pandemic will destroy. So that's something you have to be aware of. The future. That's important. You know, everybody, sometimes a lot of my friends or even my own wife doesn't understand how my mind works because I say, they tell me, geez, look at those guys. They just bought a new house. They're doing well. They got a lot of money. They look at geez, they just bought a new Tesla. Boy, those people are doing well. Yeah, but I say, how are they going to do next year when they have to start paying back that new Tesla or those cars or those houses? And what if their income drops? What type of plan and strategy do you have if something goes wrong? Are you going to depend on the government to bail your ass out every year? Are you going to depend on Gavin Newsom to lower your tax rates in California to keep you solvent? Well, they might do that once, but twice, 3 times? I don't think the investors would buy that. So these are interesting qualities that you can read out of the financial statements. Understanding what they tell you. Understanding what the balance sheet tells us. It tells us the relationship of things that we own to how we fund those things. A mix of debt and equity. And equity is a combination of stock and profits that we keep. You make a profit, you're increasing the equity position of your company, and usually that causes the stock price to go up. And look at this company. Their stock price in 2018 was $6, and this year it was $12.17. And I bet you the main reason for that was investors and the market were seeing this. Good job, guys. You're making a profit. You're rebounding from last year, and that's going to show in the stock price. But at the same time, investors like, I don't know, Warren Buffett, Rick Hasse, are saying, okay, that's great for this year, guys, but you're not creating any new growth. I don't see any huge increase in fixed assets. Who's providing the return for this? Where are your new markets going to be? Where are you investing in new growth? Are you going to have another year next year in 220 like 218, or are you going to maintain profitability? These are questions that all have to be answered, especially if you're the manager of the company. And those questions can be answered in statement analysis. The liquidity position of a company. This is chapter 3. The debt management, profitability, market value. Remember I said earlier, the market cap, the value of a company in the market is its stock price times the number of shares of stock outstanding. If I take this company's on December 31st, 2019, I take their stock price, $12.17, and multiply it times 250,000 shares of stock, I get a market cap of a little bit over $3 million. Well, if you take that market cap and you subtract out the debt position of this company, what is the debt position of this company? Let's call it $1.5 million. If I subtract out $1.5 million, I get an equity position of $1.542 million. That's the intrinsic value of this company. The market cap minus the debt position, that's what's left over. Currently, this company has a pretty good equity position of 1.9. But this is the true value of the company. Looks like the market has this company pretty well pegged. But we'll talk more about that next week. But statement analysis is taking a look at key ratios and looking for trends, looking for comparisons to the industry. One of the things I'd like you to do this week is we're going to be doing this. One moment. I'll do this after break. Is I want to show you that we can go into the library database and look up different companies' financial information and see these trends in financial analysis. It's called Hoover's database. We'll take a look at that after break. Let's go back to our spreadsheet before break. So financial statement analysis is taking a look at current ratio, the relationship of current assets to current liabilities. These definitions are all in the text, and you should know them anyways. The debt position of a company. The current debt divided by the current assets. The profit margin, what percent of sales is our profits? The return on assets, the relationship of net income to the total assets of the company. The earnings per share of the company, another way of looking at profitability. Net income divided by the number of shares of stock in the company. This is the main reporting way that most corporations announce their financials. We had $1 a share net income last year. That's compared to a negative 93 cents a share, 95 cents a share in 2018. As you can see, we had a pretty good year. Thank you. And the relationship of that earnings per share to the stock price is called the price earnings ratio. Is our company worth more than it's generating in profit? The lower the PE ratio, not the case. The higher the PE ratio, if a company has a PE ratio of 50, 80, like Tesla, the market has that company way overvalued than what type of profit, than the profit they're generating. That can cause for some alarm. It's a main investing model tool, the PE ratio. But these are financial analytical numbers that establish trends within your numbers. The financial statements are the hard numbers, but the financial statement analysis tell you the trends of the company in relationship to key models. Another one I'm leaving out here that's important, would be important for this company, is the average collection period of their receivables. The average collection period. Usually you want to collect your money within 30 days. The average collection period of this company is 45 days. Ouch. That shows why they have high receivables. So the trends in financial statement analysis tell you about the efficiency, the profitability, the leverage position of a company. We need to be aware of these 6 especially. They tell us something about the performance comparing to prior periods or comparing to the industry. In some cases, we're good with this in this company. In other cases, disaster. It paints a picture of management efficiency. But the picture that's painted the most of management efficiency is one of the numbers that most people have no clue what's going on. It's called free cash flow. The definition of free cash flow is the amount of cash flow available to investors of the company. What's left over after we pay the bills, pay our taxes, pay for our operations, pay for our long-term investing needs? What's left over to pay dividends, interest, long-term debt, maybe buy back stock, maybe invest in new companies? The free cash flow of a company. The free cash flow of a company is, for this company, is a negative $146,000, which pretty well paints the picture that we're looking at. They had a profit of $253,582, all right? But their real profit, if you don't take into account taxes, is taking the earnings before interest and taxes, basically their operating profit, $502,000. That's in earnings before interest and taxes. Why do we want this number? Because interest and taxes are what we pay after we pay for everything else in regards to operating cash flow. So we take our earnings before taxes, interest and taxes, and now we take out the tax, which is 40%. We now have $301,584. We don't include interest, that's our profit. And then from that profit, we're generating, notice remember we had those high receivables and inventory? Look at our delta of working capital from 2019 and 18. We used $550,000 more dollars in operating our working capital from 2019 and 18. Those are high receivables numbers, high inventory numbers. So our profits were eaten up by the cash we lost in our operating working capital. Because of depreciation, we generated positive cash flow in our long-term operating capital, because remember, we only purchased $17,050 of new fixed assets. Everything else was money we got back from depreciation. So the formula for free cash flow is net operating profits after taxes minus delta working capital and minus long-term operating capital. In the case of this period, we had a positive cash flow from working capital. So this minus this plus this gives us our operating free cash flow. Now, I'm never going to ask you to calculate this number. So don't worry about it. Now, if any of you are finance concentration members of our community in your MBA finance, you're going to need to know this. If any of you are going to go on to doctoral work in finance or economics, you're going to need to know this. But for most of us in this class, the idea of just what is free cash flow is all we need to know. Free cash flow is how much money we have left after we made our revenue and expenses and paid our taxes, and we paid for our operating assets and liabilities, and we paid for our long-term investments in assets. What's left over? And what's left over has to go to interest, dividends, paying off that debt position, and purchasing short-term investments. Notice all these numbers are right here. But what did we have to do to balance all this out this past period? We had cash coming in from the issue of common stock. So if you take all these numbers, minus, 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 plus, minus, we reconcile. This is why you know the bank's books are balanced. Their operations cash flow is equal to their non-operating cash flow. It equals. In order for this company, this is the scary thing, in order for this company, because they lost money on their operating cash flows, in order for this company to pay interest on their debt, to pay back long-term debt, and pay dividends, they had to issue stock. If this was positive, they probably wouldn't have had to issue stock. But they had to balance the books by selling 150,000 shares of stocks. That's the wrong reason why you issue stock. Because here's why. Issuing stock is the most expensive form of financing. You got to pay those robbers at JP Morgan Chase, the investment bankers. You got to pay accountants and lawyers to represent you in the market to issue that stock. Then you have to meet the expectations of the investors who are giving you their money in stock certificates and provide them a return every year on their money. The stock price has got to grow. You got to pay them dividends. That's a tall order. And this company is sacrificing all that for short-term management of their company. Not cool. That's a disaster. What are they going to do next year if they don't collect their receivables and inventory? And what do you do next year if they don't make a profit? You're either going to have to borrow more money or maybe start merging or finding some partners. It opens up all kinds of possibilities. But free cash flow is the number that tells us, are they providing enough cash from the day-to-day operations of their business to fund investor cash flow needs? What are investors? Debt, equity, and new investment if they so desire. If they have any cash left over, they invested in new investment. Why do you think Google, Apple, Cisco, Amazon, every time you turn around, you read the paper, they've acquired somebody else. They've acquired a new market. They've acquired a new business. They've acquired a new territory. They've acquired a new country, whatever, because they have the positive cash flow that they can do that. Where you don't see Ford Motor Company growing these days. You don't see a lot of companies who are struggling, General Electric, because they're not generating free cash flow enough to warrant investment into new areas. It gives them the luxury to do that. You want to be a manager or an investor in a company that's creating positive free cash flow, not negative.
Hey, Professor Hasse?
Yes.
It's Marianne. I have a quick question. So just looking at those numbers, the fact that the inventory is so high, would this likely be indicative of a company whose products maybe aren't, there's not the demand for them, and so they're unable to sell them?
That
Why
and
they
also
would make that sacrifice for using the most expensive form of debt repayment?
That and also, Marianne, they might be inefficient. They might be building inventory and not have any idea that they're not managing it correctly, right? You might think, some companies that struggle is they keep operating at full capacity when business is slowing down. Now with supply chain functions and Six Sigma, a lot of companies, what did they do in March as soon as they knew that that nobody was coming into their stores? What did they do within a week? They cut their costs because they had the financial data and the supply chain management information to do that immediately. A lot of companies sometimes ignore that or don't pay attention to that, and then they get bitten. That and what you just said, Marianne, is exactly right. That's exactly right. That's why inventory management, that's why one of the hottest areas of MBAs now are supply chain people. They can save companies hundreds of millions of dollars by just changing how they distribute and when to not distribute a product if they don't see the volume out there in the market. Supply chain. And I know a lot of you who work in manufacturing are using Six Sigma. And one of the qualities of Six Sigma is having the financial data that gives you a heads up right now and then about what's happening with your business. If you don't have that efficiency or can't read that, you got a problem. So this information, this is not a financial analytical class. This is not a internal audit class. Okay, that's why I'm not concerned about coming up with these numbers. But they tell us that a company is inefficient. If I show you somebody that has negative free cash flow, they either are inefficient or they had a very bad individual year. Now, if you see a trend of negative free cash flow, then they're really inefficient. Okay? Now, when we come back from break, we're going to look at where can we find this information on the internet. Some of you might already know that. But where can we find this data if we need to do that? Hint, hint. All right. And then we're going to take a look at the AFM model from chapter 12. Where does this come from? How can we look into the future to determine what are our capital requirements based on our current financial statements? Again, you're not going to have to do this analysis and crunch these numbers, but I need you to be aware of what does this mean? How can we look in the future and say, geez, we want to maintain this growth rate. We want to maintain this market share. How much assets, how many new assets we need to bring in to keep that going? It's just like having a family. You and your wife get married. You get married for 5 years and you buy your first home, a 2-bedroom house. Oh, this is lovely. You have your first child. First child uses that bedroom, all is well. 5, 10, 15 years go by, you now have 3 kids, 4 kids, and they're sleeping on top of each other. I need a bigger asset. I need to have more capital because I need a bigger home to manage my family. We're struggling with efficiency when we have kids yelling at each other all days of the night because they don't like living together or whatever. So you need a bigger house. Companies are the same thing. I'm in a competitive market. I need to expand. I need to develop new products. I need to go to a new market in Arizona, Texas, wherever. But I need capital to do that. How much capital am I going to need to do that? That's the Afm model. We're going to take a look at that definition. So we're going to look at those two things after our break. All right? So I'll see you guys back here about 7:20. 7:20. And I'll see you all back here. A good start. Catch you later. Okay, we're back. Before we had our break, we were looking at financial statements and information, balance sheet, income statement, cash flow statement. We looked at a new term for us, for some of us, the free cash flow information. We looked at statement analysis, current ratio, debt ratio, key figures that we can take a look at trends or relationships with our industry or competitors. And now the last form of what we're talking about in our financial analysis tonight, and this is from chapter 12 of your text, of which the PowerPoint is in Blackboard under week 3, is taking a look. It's called additional funds needed analysis. And that's taking a look at the current trends in your financial statements, mainly your balance sheet and your income statement, and apply that to what are going to be your capital needs going forward. Let me give you an example. When I ran my company, my fiscal year was January to December 31st. Beginning in July, I started putting together a budget for the next year. Like if this was 2020, and usually around the 1st of July, I'd start putting into a function of my budget requirements for the next year. How much I'm going to increase salaries. I usually did the cost first. What of my costs were going to be going up, or some of my costs were going to be eliminated. Depends on that too. And then took a look at my revenue sources, and then taking a look at how I expected to grow and be competitive in my particular environment. How could I grow my industry? And could I maybe expand to a new office, or get new computers, a new telephone system, whatever. All right. And if I could achieve that growth, how much profits would I could be anticipating making? And that's what budgeting is about. What's my bottom line going to be? Well, to achieve that growth and make that money, what additional assets would I need to do that? If I was going to open up a new office or get a new phone system, how much money would I make or need to finance that in the next year? That's called a capital budget. And then I would take the look at my external and internal sources within my company. Internal sources is money that I can generate or capital that I can generate myself. And there's two of them. Operating liabilities, accounts payable. I can fund some of my operations for 30 days by just billing it out, owing the money for 30 days, accounts payable. Even credit cards. How much could I fund for 30 days? It's called current operating liabilities. That's internal sources of capital. Not going to be very long, but that's a source. Excuse me. And the other internal source of capital is profits. The profits I anticipate making, I can refunnel those back into the business. Those are sources of capital that I can control. Operating liabilities, how much money I want to borrow short term, very short term, and the profits that I plan on generating through my operating budget. Once I know those numbers, and once I can determine how much capital I need, that's the Afm model, I now can go to my external sources of capital to generate the difference. I can borrow more money, debt, interest-bearing debt, or I can issue stock or find a partner, whatever. These cost a lot of money. These cost nothing. Efficient management, cash flow management, nothing. These cost. I want to stay away from these as much as possible. So the Afm model is telling me how much external capital will I need, and probably maybe I shouldn't do this because external capital is expensive. Now the premise behind this model is you assume a certain increase in sales in the next year. So let's say I was this company and I plan on increasing my sales 15% next year to achieve my profitable goals. If I maintain my cost, my operating costs and that sort of thing, if I increase 15% my sales next year, how much additional profit is that going to generate? Well, here it is right here. If my sales go up 15%, remember this year it was 7,035,000. If I increase those by 15%, and I better know what I'm doing by doing that because that requires marketing, it requires hard work. My sales are going to increase to $8 million. If I maintain the same profit margin as I had in 2019, that same profit margin, I believe it was about, where is that number? Profit margin. Oh, it's right over here. 3.6%. If I maintain that 3.6% profit margin into the next year, I take 3.6% of my sales, I'm going to make $291,000. I'm going to increase my profits by about $40,000. If I maintain the same dividend payout of 22 cents a share, there's my dividends for next year. Got to keep the shareholders happy. So my retained earnings is going to go up by about $30,000. So I got $30,000 of additional capital that I can use next year if I maintain my budgets. This 15% ratio is also going to apply to my current operating liabilities. If I increase sales by 15%, that means I could probably use 15% more of my current operating liabilities. That's accounts payable and accruals. So I increase that by 15%. I'm going to be able to come up with $110,970 of additional capital just by borrowing it short term. Cool. So I got $110,000 coming from operating liabilities. I got $228,000 coming from my profits that I hopefully make if I hit my budget numbers. Well, how much additional capital do I need? Well, again, the same premise in this model. Remember, it's a model. Is if I have $3.5 million of assets, if I'm going to increase sales by 15%, I'm going to need 15% more assets to fund those sales. There's my assets increasing by 15,000. That's a total delta of 527,000. So to hit 15% sales, I'm going to need $527,000 of assets. I'm going to be able to come up with $110,000, almost $111,000 from current operating liabilities. If I meet my budget, I'm going to come up with $228,372 of profits to fund this growth. What's the difference between delta assets, internal sources of operating liabilities and retained earnings? There it is right there. 527 minus 110 minus 228. I'm going to need $188,201 in additional capital to balance my books, to balance the needed assets with how I can come up with it from internal sources. That means I got to go to my banker and borrow $188,000. That means I have to go into the stock market and issue stock to come up with that. Or I have to go on Shark Tank, or I have to go to private investors. I need 188,000 of external capital. Well, let's say my strategy is that ain't going to happen. I'm not borrowing any more money. I'm not finding any more partners. I'm not going on Shark Tank. I'm not going to issue any stock. So I'm going to have to maybe change my strategies. Maybe I don't pay a dividend next year. Eliminate this dividend. Now, my shareholders aren't going to be happy, but in the long term, I'm making the company more, have greater value. So I'm going to use all that profit as a way of funding my 15% growth. I fit that into my formula. I'm still $124,000 short. Well, what if I cut some costs and increase my profit margin from 3.5% to 7%? What if I cut some costs? Streamline. Not losing efficiency, hopefully, but making a greater profit. If I do that, I can eliminate the need for external capital. If I increase my profit by 7%, I'm now going to make a profit of $443,000. I can eliminate the need for outside capital. The key thing here is, again, not the calculations for our class. Again, if you were a financial or a finance person, you would need to know this. The key thing here is the different strategies to achieve that goal. By taking a look at my financial numbers and what I want to get to with a 15% increase in sales, maintaining my same profitability margin and using my internal sources, I'm not going to make it. But if I change the strategy by maybe cutting some costs and making that profit margin 7% instead of 3.6, yeah, 3.6, sorry. Yeah, there it is. I could maybe achieve that goal. This is why companies, when they put their budgets together in July, August, and September, they have goals that they need to meet for investor needs, for capital needs. And that's when all of a sudden people start getting revamped. Companies start changing their cost structures for the new budget year to maintain that profitability and that capital fund flow that they desire going into the new year. So they can keep the stock price growing. They can pay their investors. They manage their finances to achieve this growth. And if internal sources can't come up with all the money, you don't pay a dividend, you increase your profit margins by cutting costs. That's a tall order, but that's what companies do. So that's the AFN model. Now,
Hey,
if I'm looking,
Jesse?
yes,
Marianne,
yes.
just a quick question. Would it ever be appropriate to say, well, we can't reduce our costs down enough to not need external funding, so we're going to reduce the 15% increase in sales?
Yes, that would be the next step. We just
Okay.
can't hit 15%. Let's try for 10. Now, the reason why somebody would say 15% in sales is maybe they think they got a great product. Maybe they think they can expand it. Maybe their marketing people and their marketing consultants tell them, you know, you guys move into these new markets, you can meet this 15% goal. You can invest that $527,543 into these new markets and you're going to hit that. But many times, especially in today's economy, companies, if I was at a company's presentation, they'd tell me in 2020 they expect sales to go up 15% next year. I'd say, what are you smoking? So you're right, Marianne. Those limits can be reduced by what's the market, what's the economy, what type of products you're producing that are able to achieve these goals if you're providing them to the market. Apple Computer and those companies can maybe do that. A lot of other companies can't. But that's another way of looking at that strategy. You're exactly
So
right,
if it was
Marianne.
very promising, you might want to just use that external financing and keep that 15% if you believe that you're going to be able to make it and make more than what that cost is going to be.
Yeah, if you can come up with that 188,000, then if that puts you in a bit more market share, a better position in the industry and against your competitors, it's worth the investment because you're going to get that money back. Once you have that market share and you maintain it, that's cash flow coming in every year. Just ask Microsoft about Microsoft Office. That was their cash cow for 10, 15, 20 years. And they just rode that for as long as the initial investment in creating that Microsoft Office was billions of dollars. But they came up with the money and made that investment and it kept paying it off over and over. And now Microsoft's one of the top corporations in the world. And then they took some of that money that after they paid back the cost of building Microsoft Office and invested in the cloud. And now they're kicking even more butt by running or owning the cloud for many things. It's amazing. But a lot of companies don't have that luxury or they make the wrong decision. Remember a few years back, you guys probably don't remember this, when Coca-Cola invested $1.5 billion in the new Coke. The new Coke, it tastes, we got to change the taste. The marketing people say, we got to change the taste. We got to go to a new market. Let's get the younger generations with a new Coke. Well, Coca-Cola almost friggin' went into bankruptcy by that decision. And they quickly got out of it fast so they could save themselves some dollars. But that almost ruined Coca-Cola, the new Coke. And going way back when, and some of you history lovers, did you ever hear of the Ford Edsel? Ford came up with a new car in the 1950s and called it the Edsel. That almost ended Ford Motor Company as a company. And look what's going on today in Pacific Gas and Electric. They didn't reinvest into infrastructure over the years. Then they had the fires. Now they have criminal indictments against the company and they got to pay back billions of dollars and they're in bankruptcy. Bad decisions about the future there. And also bad luck, the fires. So these are examples of good or bad instances where you have to predict the future and can you meet that future? And if you want to meet the future, right, in this case, come up with 188,000, how risky is it to do that in this economy, in this competition? Is it worth the risk? Very important concepts. Okay, that gives you something that you guys can chew on for the next week. The financial information of a company, its cash flow and what that cash flow statement tells you, free cash flow and what that explains to you about a company's ability to generate capital for their investors, statement analysis looking at trends both internally and externally into the operations of the company, and then a quick model of determining strategy and can strategies work right or wrong based on the capital requirements for those strategies. Wow. Now, where do I get this information? What if I'm given a problem where I'm asked to go and find a company and where am I going to get this data? I think one of the key things about graduate students and your ability to do research, your ability to find information is a key. Well, as you all know, you guys are members of the University of Laverne, and here's our University of Laverne website. Very pretty, nice, and ask me it's a piece of crap, but don't tell anybody that. But at this University of Laverne website, you can go to academics and go to the Wilson Library. There it is right there. And the Wilson Library, like any other library, where most of us now are working online or from home or doing work on the internet, it has databases and resources for us to use to find financial and business information. Financial and business information to help us do some of our work. And if you go to databases here, you click on that, and here comes everything you want to know about databases that the University of Laverne Library has. Click on business. I'm recording this, by the way, sports fans. And you go to business, and once you're in the business databases, you want to concentrate on this database, Dun & Bradstreet Hoovers. Dun & Bradstreet is a big financial data information company that provides data on all companies' financial performances. See this woman here? Her name is Linda Gordon. If you ever have any problems with gathering data, she's the librarian that's been assigned to our 635 class. She's a very nice person and very smart person. And if Mr. Hassey gives you or a situation where you have to look up some data and you don't have the time or the patience or the wherewithal to find that data, you can email or call Linda Gordon and she will help you. She is a research librarian for the College of Business, Business 635. She's there to help you. So remember that. But if I click on this D&B Hoovers, it's going to go to a login page. Oh, that's not nice. I just tested this before class. Here we go again. Let's try this again. You better work. What the F is going on here? All right. I'm going to do this one more time, but I'm going to sign out here. Let's sign out. And then we'll go back in. God, I did this right before class and worked perfectly. Wilson Library. Databases. Business. D&B Hoovers. They're making me look bad. All right, but guess what? Professor Hassey's like any smart, intelligent business manager. He always has a plan B. And here's plan B. Just a sec. Let's bring this up. Hold it. Raphael, you with me? Attaboy. All right. Tiffany, wake up. All right, you're there. All right. Professor Hassey always has a plan B, like any smart manager. I go to our YouTube site. Here it is right here. I click on, go to Professor Hassey's YouTube site. Whoop, wrong one. Here it is right here, his fat little face. And I go to the playlist. And under playlists is technology. I click on technology, the playlist, and look at that. It says Business 330, but it talks about library resources. You bring this up, and it shows you how to manage
And as you can see,
There you
this is the
go.
databases
How
for
you get into
finance.
the database
Before I
of
get to
Hoovers.
that, this woman right here, her name is Linda Gordon.
I hear an
Her
echo.
task is
So
specifically
let's get
assigned.
out of that. But that's a way if you want to use those resources, and I'll go over this again next week. Hopefully it'll be working. But that's a way of getting in. And I have a YouTube video to show you that. Plan B is it called. I'm telling you, you got to get up pretty early in the morning to get by Mr. Hassey. Okay, so but the reason I'm talking about this is because that's important, because you can go to that database and find all that information that we were just talking about. Debt ratio, financial statements, free cash flow statements. You can type in a company and that information is all there under the database D&B Hoovers in the library. So we'll talk more about that in another week, but that's something, because in next week, not this week, but in week 4, when I give you the next case, we'll try this again, make sure it works, and then because you're going to need that database for your case number 2. Okay, cool. Now, speaking of cases, might as well bring up the bad news now. Here we go. There we go. There's our YouTube, there's our Blackboard site. I hope a lot of you are beginning to get familiar with it. Wendy, do you see the site in front of you? Thank you, Wendy. So here's our YouTube, here's our Blackboard site. And now you will see, let me change this over to student view so you can see what you should, there it is. And now you see a file folder that you haven't seen before and you probably don't want to ever see again. It's called case study. And if you bring up case study, here's our first case study. I give you 3 files. 2 files are exactly alike. I give you a Word doc version, I give you a PDF version, and then I give you a file listing the Dow 2019 members of the Dow Jones Industrial Index. Your job in this case is to download these files and write them out. But you can write them in any format you desire. And when you're done with those files, you post them back to this file folder by next Sunday night at 9 p.m. June 28th, 9 p.m. they're due. Remember, I have office hours on Wednesday if any of you get freaked out about this. So if you open up those file folders, this is what they look like. Not that. Oh, let's do it this way. Let's take one of these files and download it to our desktop. Okay. And let's bring them up. There it is. There we go. Okay. So you download those files and this is what you'll see. A case study. Now, all case studies, and I think we've talked about this, and even in our individual sessions, a case study is an area where you have to interpret, calculate, and tell me what happened in certain amount of situations. The situation for this week is called risk and return, capital financing. I give you 4 questions where are examples of capital financing. And remember, we went over them at the beginning of class tonight, and we went over them last week. Present value, future value, bonds, stocks, risk and return, capital asset pricing model, blah, blah, blah. I'm asking you a series of questions. Now, this is formally ending what I call our review section of our course, but I'm asking you to do some calculations. I'm asking you to figure out some numbers, and I'm asking you to go look up some numbers and then tell me certain things that those numbers tell you. All right, that's this case. All right, it's not one big problem, it's 4 different problems. 4 different things that I want to see if you have mastered and or can do these. Now the format for this case is whatever format you want. You can do it in a Word file, you can do it in a PDF file, you can do it, now some of you might need a spreadsheet to do the calculations, a spreadsheet file. Might give me multiple files. You pick the file. I'm not going to tell you for this first time out. I decided not to this week. So you pick the format, just answer the questions. So the first questions has to do with present value and future value. A company has some cash flow going out in the future. What is its current value today? You plan to buy an asset. What is going to be your monthly payment on this asset? What is debt? How are bond ratings determined? What is the definition of if bonds drop in face value? What happened when bonds lose value? What happens? What's going on? General Electric has been one of the dogs with fleas in the stock market for the last 10 years. It has lost significant amount of value. As an investor in General Electric, please give examples what the above means of General Electric's decline in relation to your investment. Let's say you purchased 100 shares of General Electric stock at the beginning of January 2002. Where is that stock today? Little internet research there for you. And then question 4 is more internet research. You are to go to the Dow Jones Industrial Index, which is 30 companies. You pick one. And I want you to find some things about that company. What is its credit rating? What's their credit rating? What's their beta? What is their required return on equity investment using the capital asset pricing model? Remember, we looked at that last week. It's in chapter 6, and we looked at it again tonight. I'm giving you the risk-free interest rate, and I'm giving you the market risk of return. You have to find the beta of your company that you select and tell me what is its required return on investment? What is its capital asset pricing model percentage? This is going to lead us into other things next week. I want you to do that calculation. I give you the risk-free rate. I give you the market return rate. You have to determine and find and locate the beta of the company currently. You can do that in Yahoo Finance in about 10 seconds. And then you put all these together in that capital asset pricing model and you come up with a percent. I want to see you do that in your analysis. That's it. That's showing the risk of the analysis. You're showing me their credit rating, A, AA, B, B minus, C plus. You're showing me their beta, 0.5, 0.7, 1, 1.3, 2, whatever. And then you're calculating their required rate of return on their investment using that capital asset pricing model. So you're doing 4 different things. You're doing some risk evaluation of a company that you select, of a real world company. You're looking at the history of General Electric over the last 18 years and what that means in regards to an investment over that time. You're telling me the definition of debt and corporate bonds, which we talked about earlier today and last week. And you're doing some present value and amortization calculations to see that how you work around a spreadsheet or a calculator to come up with those numbers. This one we actually looked at last week and tonight. This one you got to be a little bit more creative. I'm trying to see if you guys can do that. It's all in the text. It's all in videos in Blackboard. It's all right there. Put this all together in a file or files. Post it by next Sunday night at 9 o'clock. Post it. I don't want to get, oh, I missed class on Monday and I didn't look at the video and I'm going to email you the work, Mr. Hassey. Is that okay? Yeah, go ahead. And you'll get a 0. All right? You know, this, I mean, Wendy works for Wendy works for the government, works for an organization. And if Wendy told her boss, I wasn't really paying attention and I didn't know when you wanted the work done, is that okay? Wendy, get the hell out of here. I'm going to find somebody else. So please, sorry about that impression was not Wendy. That was just me acting like a student, and that was awful. That was not very nice to do, but it's funny. All right. But I want you to do the research, present it however you see fit, so I can intelligently understand what you did and what you came up with. And then you post it to the Blackboard file, and here's how you post it. Many of you have done this before. I'm sorry to bore you by all this, but let's just make sure we're doing it the right way. There you go. No, that's not it. Oh my God. Excuse me. There we go. Okay, so here's case number 1 file folder. So next Sunday night, probably for some of you at 8:59 and 30 seconds, you click on this file folder, and all you have to do, this is the upload file, and you go down to here where it says assignment submission. So you would go to browse my computer and find a file. Let's say you have a file on your desktop. Let's take this one. You hit open, and now all you do is submit it. Or you can just take your desktop file and drag it into this box, and it will take it. And once you hit submit, it's now sent to Professor Hasse, and he can grade it. You also can put in some comments. Professor, you can put in some comments if you really feel you need to. And the comments are, Professor Hasse, you are a striking looking man. That's a good thing to say. Or Professor Hasse, you are a fool. Maybe not very good public relations, but you can say that too. And you can send me a little note. Or you don't have to send me anything. Just send me the friggin' file and hit submit, and then I will have it to grade. And then I will grade it and send it back to your grade center with the solutions and my comments on your work. This is worth 15% of your course grade. If you're having difficulties, text me, email me, come to office hours. I'm here to help you, but I won't answer you the questions. Again, you chose the file format. You want to do it on Word, you want to do it in PDF, you want to do it on a spreadsheet, so you can have a spreadsheet for your calculations. You do it, but I just need to have your work sent to me by next Sunday night. If you look at our calendar, we have a couple of these coming up over the next few weeks. All right. So anybody have any questions on how to do this? Cool. Okay. That's our first case. All right. You have a week. Well, you have 6 days to do it, and plenty of time. My advice to you all is do this in the next couple of days if you can, while it's still fresh in your mind. If you wait to the weekend, then maybe you might want to download or upload or go to YouTube and look over the class lecture again. You figure it out. But usually most students try to get this, at least they might take a look at the case and go, oh, I have no idea what's going on there. I got to think about that one. Let me knock out the ones I can do right now, today or tomorrow or Thursday. Get those out of the way, and then I'll worry about that one that I have no idea what the hell Hasse's talking about, and look at that one on the weekend when you can take your time and maybe go back through the lecture or go through the Blackboard notes. okay? So that's our work for the next week. The first case study. It's designed, this one is designed, I'll be perfectly frank with you. I want to see you able to calculate numbers, go to the internet, do some research, apply that research to the question at hand, and tell me something. It's telling me, you're showing me your ability to do that. And then when we get into other cases and other work, now I know you know how to do that. Now I can go after your mind and your thinking. Okay, but this is telling me where you stand as far as gathering information, basic financial principles, financial tools, and putting that together. And doing some research, going into the internet to finding these things. No financial statement analysis, just calculations looking for data. Fair enough? Fair enough. And again, remember, we have office hours, and if you can't make office hours, you can say, Mr. Hasse, are you available at this time? Can we click on Zoom? Or Mr. Hasse, let's meet at a bar. Let's have some cocktails. No, let's not do that. Only if you're buying. Okay. All right. As you can see, we have our usual contingent of people who have no video on this evening. But let me go make sure everybody is cool. Joanna Martinez, is everything all right?
Yep, Professor, everything's good here.
Good. Carrie Castillo, everything okay?
Great over here. Thank you.
Teresa Rodney, everything cool?
Everything's good here.
Vivian Cow, everything all right? Bueller? Oh, Vivian. Oh, thank you, Vivian. She sent me a chat. Okay. Daisy, everything okay?
Everything's good, thank you.
Salam, glad to have you back in the class. Good to see you, buddy.
Thank you.
Wendy, you got to find some different background, but we'll let that go. Chat. Oh, Vivian's okay. Remember, all your grades are up to date. All your grades are up to date. If you see any problems or concerns there, double check your cumulative average in the course and either get with me or make sure you understand what's going on with your grades, because now for the next 5 weeks, we have a grade every week. So make sure you know where you stand. Make sure there's no issues that you know of the original 2 discussion posts that we have done. Make sure you're okay, because the grades are now going to be coming fast and furious. All right. Joey, thank you, buddy. Appreciate it. Paulina, I didn't call you because you're too dependable. I know you're there. You're not falling asleep like other people. I know you're there. That's fine.
Okay, thank you. Thank you.
Thanks, Paulina. All right. All right. Now we're coming to the end of our class for this evening. We've covered all the basics. I apologize that we didn't be able to look at the Laverne database, but again, there's a video for that, and you really don't need it for this week's work anyways. You can go to Yahoo Finance, you can go to any places to get that information. And I've provided most of the information for you already, so you don't really need that database. Elizabeth, thank you. I saw you there. Thank you, dear. And so you're all set for this week's work. It should, for you guys, this should take you an hour to do. Yeah, right, Mr. Hasse, an hour. Yeah, right, sure, right. It should take you about an hour and a half to do. All right, guys. As usual, I'm going to stay on after class and answer any questions that I can help you with this evening. If not, this version has been recorded. It'll be up on our YouTube site and the link in Blackboard by tomorrow morning. How many professors do this? How many professors give you this information, this backup? Mr. Khan, watch me. There you go. How many professors provide this information? Really? Really? Come on, give me a break. All right. And next week in class, I have some new fun little things for you. We're going to be doing some things online, already doing work interactive online next week. So hang on to that one. It's going to blow you away. So look out. All right. So I'll stay online if any of you have any questions. And I wish you all well this week. Be well. Take care of yourselves. Stay away from groups and large groups. According to this afternoon, this virus is starting to kick up speed again, so be careful. Wear a mask. Maybe you should have a class next week where we all wear a mask. For some of us, especially me, that might be a helpful hint because I have an ugly mug. But maybe next week could be mask week. I don't know, that might not be good. But we'll think about that. All right, everybody, have a good week, and we'll talk to you next Monday. Adios. Alicia, are you there? Alicia. Adios.